Hey guys, welcome back. This is actually Marcos Rubio and Marcos Rubio. Today we're actually talking about different types of loans. We're going to talk about only three specific ones. The first one we're going to talk about is what?
FHA type of loans, which are government insured loans. Government insured loans means that you're going to be paying a mortgage premium insurance every month for the entire length of your loan. It'll never go away, which can be pretty pricey.
Yes, it can. Some people really think when they say, I want an FHA loan, I want a government loan. It's really not a government loan, just like you stated. It's government insured, ensuring that the borrower, that when you buy the house, it's insured in case you ever foreclose or lose your house, the bank gets paid for the actual loss itself. That's really comes down to. So keep in mind, it's a government insured loan. That's the first thing we're going to talk about. And within this FHA type of loan, you could get, a home with a lower, I should say, FICO score in the 500s, but you preferably want to be at least in the 660 to 680, close to 700. And the reason I say that's because an FHA loan is really a little bit easier to qualify for a lot of borrowers in case they have a little bit of credit items you need to work on or whatnot that they cannot use to be able to buy a home with a conventional loan, which we'll talk about in a second. But one thing that people kind of have a misconception on with a FHA loan, they kind of think it as it being like a first-time home buyer loan that they could
One
only
and done.
Yeah.
So it's not the case at all. You could use FHA repeatedly over and over and over again. It doesn't matter. I've had people call me and talk to me before and say, well, I want to buy a house, but I think I already used my FHA loan. You could use it repeatedly over and over again.
Yes. So yeah, especially if they're selling their one house and trying to purchase another house, they
Right.
could switch it over and buy another home with FHA. So it's not a first-time home buyer program. People tend to think it does require at least a 3.5% down, which is one of the lowest amounts down to be able to get in a home. But it's easier to qualify for a lot of borrowers itself.
Right.
But if you have someone that has a little bit higher FICO score, or actually they're a little bit better on their credit and whatnot, and they're in the 700s, which program should they actually look at?
I would recommend going conventional. Conventional, sometimes FHA to conventional makes you look like a little bit more of a stronger buyer because you need a higher credit score and you need to have a little bit less debt to qualify for conventional. Now, it doesn't matter if you put 3% down, 5% down. It's that 20% that really takes away your mortgage insurance for conventional. But typically, after how many years does it just fall off naturally?
You know what? If someone actually keeps paying on their mortgage, say for the next 5 to 7 years, as they're paying down and the equity starts to increase, provided that's the trajectory of the value of the property as it increases, you're paying down that mortgage. They could probably get rid of their mortgage insurance probably about 7 to 8 years typically if they call in
only conventional.
Only conventional, because FHA, the mortgage insurance stays with the life of the loan. But in about 7 years or so, it could actually come off, provided you're paying down your mortgage. If you want to pay a little extra, pay down extra, but provided the value also increases to give you at least 20%. As soon as you get 20%, you can actually call your lender and ask them, hey, could you review my property without doing a refinance just to remove the mortgage insurance? If they say yes, if you call with 20% equity, it'll come off. Now, keep in mind too, a lot of people don't understand this. When there's 22% equity and the lender sees that in the system automatically in about the 5 to 7 year mark, it'll come off automatically without you even bother calling. But that 20% mark is when you have to give them a call. A lender's not going to do it unless you call them up for that 20%. But that's one thing people don't think about. People tend to refinance after the 5th year, 6th year, or whatever, thinking they have to refinance to remove that mortgage insurance, which you really don't.
Right.
So with the FICO score, roughly you want to be at about 700 preferably to get a better interest rate. So does somebody always have to put, I've heard this with certain people, I have to put 20% down on buying a home. So if they're a first-time home buyer and they have a good credit score, what could they get in a home with?
As little as 3% down. That's going conventional. FHA, it's always 3.5% down. But conventional would be 3% down, and that would be considered what people call first-time home buyers. Not to get confused with down payment assistance. First-time home buyers is using 3% down for your down payment on a conventional loan.
Very good, very good. And a lot of people tend to think also getting into this first-time home buyer thing. some people think that they're no longer first-time home buyer. For example, in 2008, when the market collapsed, people actually owned homes and actually decided they had to rent, and they were forced to rent for many years. And they thought because they bought back in the day, 10, 15 years ago, 12 years ago, that they could no longer buy a home and be a first-time home buyer going conventional 3% down.
Right.
Not the case.
Right.
They just cannot show that they've actually had ownership of the property for the how many years?
Total of 3 years. So that's 3 years of not having your name on title and 3 years of not claiming the interest. Because when you're a homeowner, there's specific benefits of owning the home. When you do your taxes at the end of the year, you can write off all the interest that you paid on the property. So to be qualified at 3% down conventional, being first-time homeowner, is not having your name on title for 3 years and not claiming interest on the property for 3 years, and you can qualify again.
Yeah, with 3% down versus the typical, a lot of lenders typically go with the 5%, which is standard going conventional.
Right.
But if somebody qualifies as a first-time home buyer, has a credit score, stable income, whatnot, 3% down is the best way to actually be able to go in the home. The last one we're going to talk about is what type of loan?
It's a VA loan. That's a veteran's loan. So that's being either active military or you served service in the military.
Yes, you're a veteran. The biggest benefit is really you're coming in with how much down with the VA loan? Big fat zero. They're actually coming with nothing down. There is no mortgage insurance versus with FHA and conventional where you have to put 20% down to get rid of the mortgage insurance for conventional, or going FHA. If you get an FHA loan, you have to pay mortgage insurance through the life of the loan. With a VA loan being zero mortgage insurance, huge benefits for the veterans itself. You're not putting nothing down, and on top of that, you're not paying any kind of mortgage insurance. And normally with the rates, interest rates typically look very similar to the lower rates when it comes down to the better of the three. So that's definitely something. So if you're a veteran, first thing you want to use is your VA loan. I've seen a lot of veterans in the past that actually got conventional loans where in fact they probably should have used their VA loan. But other than that, I think we're good. Hopefully you have any kind of questions, reach out to us. But if you're looking to get qualified, want to buy a home, or have questions about selling a home, whatnot in the future, reach out to us or reach out to someone that's actually recommended, referred to you by a family member or friend that you trust, that they trust. If you don't have anybody, reach out to us directly. Otherwise, it's a wrap.
Yep.
Thanks a lot.